Hello guys, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video of Enterprise Products Partners L.P, ticker symbol EPD. This stock is a pipeline company with over 50,000 miles of pipelines, storage capacity, processing plants, and marine terminals for natural gas liquids or NGLs, crude oil, natural gas, petrochemicals, and refined products. And a lot of their money is made almost as a kind of taxi service for moving these natural gas liquids or the crude oil or the natural gas. So basically, if I wanted to move this much natural gas to this place, it could be cheaper for me to do that in bulk from EPD. Or if I have a data center and I need energy there, EPD can help me out with that. So they make money based off of the overall demand of the things that I just said, but they also make more money on their fees if the overall value of these things is higher because it's going to cost more to move them because they're worth more. So this has a lot of sensitivity to those aforementioned kind of these have a lot of sensitivity to that those NGL prices, crude oil prices, natural gas prices, and the petrochemical prices. I mean, those things definitely are going to be affecting EPD. So if you don't want to get into a stock that is sensitive to oil pricing, I don't think EPD would be the right pick for you. The stock does have a very high dividend, but I wouldn't expect like future insane growth. I think that overall we can look at what the valuation is from this model. I think that we should be very conservative about it, just so that we don't get our hopes up. Because again, this stock, we should be very skeptical of this stock because there isn't going to be a lot of future growth. This stock is going to have very well preserved value with very secure cash flows. And if management's doing everything intelligently, then it should be able to deliver that high dividend yield to us, the shareholders. Um, Now, overall, the market cap of this stock currently sits at $66.41 billion. The price to earnings ratio is 11.45, which is fairly low in the market. The annual dividend yield is 7.11%. 52-week high is $34.63, and the 52-week low is $27.77. The quarterly dividend amount is 55 cents per quarter. Now, I think, and this is my kind of thesis for a lot of the defensive stocks in the market and why I'm rotating into more. I mean, and personally in my own portfolio, and again, none of that is a recommendation. Don't do what I do. I'm not a professional. I'm currently buying Vici and Waste Management right now. My thesis for that is that it's going to be very similar to companies like EPD, where people have really rotated out of a lot of the defensive names. And I think that the momentum's more going towards AI, but I think that over time, these companies are going to have real earnings. And I think EPD is going to be one of those companies that actually benefits well off of the AI surge. And I think that there's a lot of real value in their pipeline infrastructure network. And I think that these things can take a lot of liberties right now, given the current political situation. But I think that these companies also get the benefit of being more valuable in times of more liberal administrations because it's more difficult to get the kind of permits and things like that during a liberal president's tenure than it is to get, like, for example, Trump. He always says drill, baby, drill. It's easier for them to be able to implement new pipelines and new systems during this time. So I think that there's going to be probably good growth. I think that a lot of the legislation is going to favor this company over time. So I don't think in the short term there's a lot of political headwinds for EPD to be worried about, just personally. Now, I know that a lot of these companies have pipelines to Canada, and I imagine that that's something that is going to hurt EPD. They have 50,000 miles of pipelines. Um, but I really think that the business overall is going to do very well, and a lot of analysts think it's going to do very well as well. Currently, 12 out of 19 analysts currently have a buy or strong buy rating on EPD, with their analyst 1 year price targets ranging from $32 to $40 and averaging at about 35.83. Currently, I think the stock is going to do very well going forward. Also, 7 analysts have a hold rating. Just wanted to add that out of the 19. So not everyone thinks that this stock is going to the moon or whatever. And I definitely think that there's going to be subpar earnings, that this probably isn't the best defensive stock that you can possibly be buying. But I think if natural gas prices increase, or you think that oil prices are going to increase, then this is probably one of the best stocks to be owning right now. And I think if you believe that the data center story is going to be something that carries into the future, I think that EPD could be excellent. But you just have to have those personal opinions about those things to be able to make your own informed decision about it. Because someone else may not think that the AI thing is going to be around forever. They may think that it's a fad and it's a bubble, that it doesn't make sense, whereas someone else may be more optimistic. And I think EPD would be a good, solid, more defensive stock for that. If you already believe that those success things are baked in, maybe you purchase a little bit of more something very high growth that you believe is going to increase. And then you also buy a little bit of EPD on the side just in case things don't phase out. You still have a lot of value there. So that's just some food for thought, just kind of talking about what I would do if I was in that situation or if I was that type of investor. But here we have a cost of debt after tax of 4.188%, a cost of equity using CAPM and a risk free rate of 4.08%, with cost of equity of 5.774%. We have current debt weighting of 32.7% and a market cap weighting or equity weighting of 67.3%. And after multiplying each of these values by their respective weightings, we come to a weighted average cost of capital of 5.21%, which we can then use in this model. So plugging that percentage into the model and using that as our discount rate, first off, we can see that revenue is kind of jumping all over the place. It's not very consistent, but it does look like it's overall trending up, which is a good thing. And that makes sense as probably oil is also trending up. Now we can see though that average revenue growth has been 9.63%. That's because we've had some really weird outlier years. But if we take out the jump from 2021 to 2022, which I imagine was a huge increase due to just the difference between COVID and then coming out of COVID, I'm guessing that there was a lot less energy consumption just overall because people were just at home. So that makes sense to me, but I don't think that the sustained revenue is going to be able to hold us steady. I think it's going to be around 54 to 60 maybe. That's going to be kind of the future, but the trailing 12 month is lower than the 2024 figure, which is kind of cause for concern, especially when you consider that from 2022 to 2023 we went negative 14.56 over that time period. So I definitely think that inconsistent revenue is something that I'm not a huge fan of, but if you think that you can play kind of again those commodity prices and you think you know which direction those commodities are going, I think that that would help you to make a better educated decision about this. But just from modeling it, even with a negative 2% growth rate on the stock on average for the free cash flow, and you could see that with a perpetual growth rate of 2.5% and our discount rate of 5.21%, we currently have a DCF of $34.75 or still 13.3% upside, which I think is very realistic here. And I really think that overall, very defensive stocks in the market right now are being really, really discounted. And I don't think that they're being given an appropriate premium when you consider the fact that we probably will have higher than expected inflation once we get a more dovish Fed chair. And there's a lot of catalysts that can really make EPD a very attractive investment to investors, especially when you also consider the fact that if they have such high debt, it's not going to matter as much if the inflation's increasing at a very high rate because they're going to be able to make more money, and then their pipes ultimately are going to cost less money as well. But they're also going to really just retain their value very well over time. I think that this is a very conservative play. I think that it's a value play that could make sense if you think that those things are going to go the way that are going to be positive for the company. I think that you could hit some huge growth catalysts that could be surprises. But I also think that this stock is very likely, in my own professional opinion, undervalued based on just these metrics. And I really think that these stocks, they just have periods where they trade sideways, even though they're clearly undervalued. And a lot of the analysts agree that they're undervalued. It's just that the big money doesn't want to be there because they'd rather get the growth play from the AI trade. So I think this is a good stock. I think it's a good time to be buying, simply because you're not buying the 52-week high. It might be something that I might look at for my own personal portfolio, but I think that this is a very, very interesting play, and I think that it probably is undervalued just from my unprofessional opinion. So thank you guys for watching. I hope you guys enjoyed. I really appreciate all the support from everybody, and I hope you have a great rest of your week.